Welcome to Asset TV's Boutique Connect update with me, Joanne Bainham. Today I'm joined by Gavin Wood, Chief Investment Officer of Camissa Asset Management.
Morning, hello.
Welcome back, Gavin. Lovely to have you back.
Thank you.
When I think of your funds, they certainly have a size advantage, and I've heard you present about this on many occasions. Tell me more about how you see size in the equity space in South Africa giving you that advantage.
Yeah, I think it's a slightly subtle point that I think it's really, really important. And that is that there is a very high concentration in the South African equity markets. And what I mean by that is the large companies make up the bulk of the value that's available to be purchased. So the top 20 stocks, the top 30 stocks make up a significant portion of the market's value. And then thereafter, the size of companies drops off precipitously. And on the fund management side, you also look at companies that have large market shares, and they have a very large portion of assets to manage. So you have a large pot of assets to manage where the bulk of market share sits, and some of our respected large competitors have upwards of 300 billion rand in equity assets to manage, to invest in the South African equity market. Obviously they've got bonds and global as well, but just in the South African equity market. So if you think about that number, roughly 300 billion rand, and then you think about 1% of that fund, what a 1% holding would look like, that's obviously 3 billion rand. Now, there are many, many companies and some household names that are 3 billion rand in market cap. So to get a 1% position in a fund of 300 billion in size, you'd have to own the entire company. Now, clearly that's not going to happen. You'd delist it and there'd be real problems. So let's say you own a very large percentage of a company, 25%. That's 0.25% of a large manager's fund. That's just not going to move the needle if that's a really good stock pick. And I think upwards of 25% is very rare. It has a number of problems in that you're effectively there for life. You're an anchor tenant that's not going to be able to move, and it's not going to move the needle in terms of performance. So if you are a much smaller manager of SA equities, you have an ability, let's say 30 billion in active equities. You are 10 times smaller, you are 10% of the larger manager. So that 3 billion rand company, if you owned 1% or 10% of it, which would be 300 million rand, 300 million on a 30 billion base would be 1%. So you could quite conceivably get a 1% position. So those are just simple round numbers.
And I guess it's giving you an awful lot more choice, isn't it?
It's giving you a whole lot more choice. So there are a whole lot of companies, and some examples in our portfolio would be Spur, which we really like. It's a very well managed company, household name, has growing market share after COVID, and COVID has laid waste to a number of the competition who weren't able to survive. It pays a really good dividend, has grown nicely and has got a great proposition, is turning around its more pizza pasta propositions, is growing its Rockamama's proposition, it's growing at the high end, the Hussar Grill, and etc. It's a great company, we think, and we own something like 1.8% of our equity funds in that, and it's just not possible to have that even if they own the whole of that company if you were a larger manager. So that's one example. Another example in that sort of size range would be Sea Harvest, where we also own around about 10% of the shares in issue, and it's also a 1%-ish position in our funds. Then you'd move up the scale, and let's say you're looking at a 5 or 6 billion rand company, and here I'd quote examples from our portfolios like Famous Brands, also in the fast food and the restaurant space, very well managed company, also an excellent economics, also a franchise model. And we own something like 3% in our portfolio, so reasonably substantial stake. And that's a 6 billion rand market cap, or 5 and a bit billion market cap company. So a large manager, if they owned 25%, they might own 0.5% in their portfolios. So those numbers sort of double up. And then one could move up a little bit higher, and another one in that space would be, say, Cura, which is also large in our portfolios, which is also in that 6 billion rand market cap space. And then if you move up to, let's say, 9 billion or so, in that sort of range, so two large holdings of ours would be Omnia, which is, we think, very, very undervalued, and we have around about 4% in our portfolios, which is very meaningful. If that does well, that's going to really move the needle in performance. Or data tech, also around about 4% in our portfolios. Those are around about 9 billion rand companies. And it's just impossible for those larger competitors of ours who own the bulk of market share in our market to replicate those positions in their portfolios. So if they like those companies, and some do, and they wanted a position in their portfolios, it would be very small in their portfolios and would contribute a very negligible amount to their performance into the future, if those are good stock picking ideas. So the point I'm trying to illustrate with these numbers is really that as a more medium-sized asset manager, we have a lot more choice of what equities, SA equities, to put into our portfolios, and therefore we can be very different to the competition and benchmarks and the large competitors in particular. And obviously we've got to get those calls right. But I think the possibility of very distinctive performance exists for medium-sized asset managers, whereas for larger managers, you're by and large sticking with the top 20, 25 stocks, which are going to be meaningful in your portfolios. And if you blend a few of those together, you're really looking at a top 40 index fund at active fees.
But now, listening to you, say you have some standout numbers and your returns are absolutely incredible because of this opportunity set that is not available to other larger managers. Would you get to a point where you say, well, to protect our returns, we would cap our funds, no different to what they do in the hedge fund space? Is that something as a company Camissa would do? Yeah,
we have very much undertaken to our clients to do that. And our number is, and we're looking at what we call active equities or aggressive equities, where we are unconstrained by benchmarks and we can invest right across the market. We've said that around about the 60 to 70 billion rand in assets in that environment, in that franchise of ours, is where we'd want to cap. And further than that, growing above that, one would be getting into a space where you degrade your competitive advantage. And so if we had a franchise, we do have a franchise which we call a core franchise or benchmark cognizant franchise, which by definition, and clients know this, is large cap biased and is aimed at lower tracking errors. That proposition, which is also a lower cost proposition, that is reasonably scalable. And whereas our aggressive active funds, and to the extent that that's part of a balanced fund or any other fund, that we'd constrain in the 60 to 70 billion rand category in today's money terms. And that would give us, we think, a reasonable choice to express the views. We can have a very large cap dominated portfolio if we want, and some of our largest positions, like a Process, are the largest company, whereas we can also have very large positions in Omnia, Spur and others that I've mentioned.
So two different equity funds.
Yeah, so I think 60 to 70 billion rand cap of the active equities franchise.
Now, Gavin, I know you love talking about stocks. It's your absolute passion. In the last quarter or so, have you made any changes to your portfolio? Any new ideas that have come into the fund?
Yeah, I think that often we sit on our portfolios for quite a long time and the percentages might move a little bit, but we take a long-term view unless prices move aggressively and we then may sell out. So generally there's quite a lot of stability and continuity in our portfolios, but two new-ish holdings in our portfolios would be We Buy Cars, which is listed recently. So it's a new listing. It was accessible via Transaction Capital in the past, which had other businesses that you'd want to get comfort from, and SA Taxi is the one that's in deep trouble. And then they've got a debt collection business that is also part of that and is now part of the listed Transaction Capital. And then Transaction Capital is separated from We Buy Cars, and We Buy Cars has listed. So that is now around about a 9 billion rand company, market cap in total. And we participated in the listing and have a reasonably sized small position in our fund. So that's one. Interesting company, very entrepreneurial culture, has grown from a startup 20 years or so ago to something that's selling upwards of 12% of used cars in the South African market. And I think most South Africans would be aware of their adverts and their warehouses and their
we
presence.
Can't avoid their advert.
Yeah,
yes.
And I think they offer a very interesting consumer proposition A, on selling your car, and B, on the supermarkets that they have where you can go and view a large number of cars in one morning. And I think they're very well managed. They've got the great smart use of technology. So I think really good company which has got quite a lot of growth and a lot of growth aspirations. At least whether they achieve it or not, I don't know, but they've got potential for growth. And so that's a smallish holding, it's new. And then the other one that's new in our portfolio, which we haven't had for a very long time, is SPAR, which is also a household name for most South Africans. Mm-hmm. And SPAR is one that has essentially, while we're talking about market caps, has halved in market cap over the last little while. So SPAR was around about a 40 billion rand market cap company in its heyday of popularity, and it's fallen by over half, over 50%. And the reasons for it falling are a couple, but mostly they've made two major mistakes. And one is that they've, as a typical South African company, and often these South African companies who do well in their home market have done this historically, they get confidence up and then they go and buy businesses overseas, and sometimes it works out, very seldom, and most of the time that doesn't work out. So in SPAR's case, they've bought with debt, they've bought an Irish business, a Swiss business and a Polish business, and those in that order, and those are the order of quality of business that they bought. So the Irish business is fine and doing well under their ownership, and the Swiss business is okay, doing reasonably well, not so well, not wonderfully well, and then the Polish business is a disaster, which they overpaid for. It's a subscale business that is a disaster, and they're now on record as wanting to sell. The big problem with what they've done is they've levered up in euro and Swiss franc debt, and obviously the rand has weakened a lot. So and interest rates have gone up a lot overseas. So you've got a situation where their interest burden is much higher. Their debt has ballooned, it's tripled in the last 10 years, their debt on their balance sheet. And they have recourse, that debt has recourse to their South African business, which is the cash cow. So that's mistake number one, was a mismatch of currency and buying poorly overseas. Second big problem that they've run into is they've implemented new systems locally, and they've implemented SAP locally in their warehouses and their logistics business, and that's been a disaster. And their profitability over the last year has halved in South Africa.
Halved.
And that's not because their sales have been problematic, like some competitors like Pick n Pay have had disastrous market share losses. So the SPAR retailers haven't shed market share at all. But what's happened is that SPAR is a wholesaler that sells to those retailers, and in between SPAR and the end customer who goes and buys at SPAR, there's been a disaster. So they've mismanaged their stock levels, and their franchisees have had to source elsewhere, and their costs have ballooned. And so essentially their margins have halved, their gross margins, their operating margins have halved, and their profitability has halved.
I'm just curious, if you see a company take on SAP, is that an immediate red flag? You hear this so often.
It's a subtle one. Somebody I know works at SAP and is a senior SAP consultant, and he tells me that it's often a reflection of the company that's implementing SAP rather than of SAP. Because SAP is a Rolls-Royce,
yes.
Very, very highly rated, very highly functioning system. If you're a company and have a patchwork of systems creaking and held together by a Band-Aid, and you then migrate it onto SAP, it's a massive project. And I think that's where, and often the company implementing SAP doesn't admit to that. And they'll never admit that they're coming from disastrous systems. And that's often the case. It's the system that they're migrating from is a disaster. And then that's why it's so difficult, I think. I'm not an expert in this area. But
well, I'm saying it's not the first time I've heard someone complain about it.
Certainly not the first time, yeah. So what's happened at the company, the board has changed. There've also been some high-profile scandals with previous management and nepotism and things like that, and conflicts with some of their franchisees. The executives have changed, and the board has mostly changed. And we have spent quite a lot of time with the new management and new board, and have gained quite a lot of comfort that they have their problems under control, and there are many levers they can pull to correct their mismatch of debt and sell off their Polish loss-making business, and raise debt and reduce that debt burden, and then turn around their South African business to get it back to where it's been for the last 30 years or so, as a very economically strong cash generative, high margin retailer or wholesaler that has a franchise model.
So I'm guessing you're taking opportunity here when the market doesn't like the stock very much because of its history. And
Yeah,
you've done
so
your
it's
homework
recent
and saying
history.
it's very
Yeah.
recent history.
Yeah.
You've done your homework and you think the future looks brighter.
Yeah, we think that they're able to turn their business around, and I think the key thing for us is that the sales at the SPAR stores are not being impacted. And so the consumers, that proposition is still resonating, and it's not just SPAR, it's also Build It, very successful building supplies hardware store, and their liquor business also done very, very well, Tops. And so it's I think their store base and their stores and their model of franchisees managing their local store for the local community and sourcing locally so that they can have an offering that is tailored to what the local community wants is very powerful. And that entrepreneur, that franchisee has skin in the game and is has real motivation to make a success of his business. And I think so that model, I think, is very much intact and has lots of positives for it, going for it economically. I think they'll get through their temporary hiccups, and that's the position we're taking. And I think the reaction of markets is always to overemphasize the negatives and to get overly pessimistic, which I think investors are getting overly pessimistic about their debt situation and potentials for rights issues and other capital raises and doomsday scenarios, and we think they've got many levers to pull to correct those issues.
Gavin, we've run out of time, but thank you very much for your time today. Thank you.
Pleasure, thanks a lot.